All right, we're recording. Do slideshow.
Okay, so today, Connor and I will be discussing global income inequality and whether it is on the rise. So to start with what is income inequality, it's pretty much how unevenly income is distributed among the population of a certain society or within a certain country. And this map basically shows the wealth share among different countries in the world. So you can see that Russia is a pretty dark shade of green, and that means that the wealthiest individuals in Russia, or the top 10% of individuals, own the majority of that country's wealth. So their wealth share is pretty uneven in that nation. And there's also a similar issue within the United States here, and you can see that it's a darker shade of green as well. So the wealth here is also somewhat unevenly shared or owned. So the next slide, there is just a video from the Wall Street Journal that we thought basically shows further what income inequality and helps explain what it is. So I'll play that.
Video says the approval process is similar throughout Latin America. We'll need first-hand experience in each country.
And BDO can find these people.
Video has these people.
People who know BDO.
Wealth inequality is the gap between the rich and everyone else. And it's common knowledge that in America today, this gap is as wide as it's ever been. One of the people calling attention to wealth inequality is Thomas Piketty. He published a book in 2014 called Capital in the 21st Century. It made a big splash because it said this gap between the rich and the rest of us is only going to get wider. Some people quibble with Piketty's numbers, but in general, experts agree this gap is widening. Let's say person A has $10 million. Let's say person B makes $100,000. Person A has enough of a financial cushion to invest his savings in things like land, equipment, company stocks, maybe a master's degree. Over time, these investments yield a higher rate of return than the rate of growth of the economy in general, which brings us to person B. Say he's working hard and making $100,000. Year over year, the salary he gets for his labor alone won't increase fast enough to keep pace with the money person A is making off his investments year over year. Thus, wealth inequality. 30 years ago,
Okay. So that video just basically helps explain how income inequality worsens or how it becomes an issue. So there is evidence that global income inequality is on the rise, and that's because the gap between the rich and the poor is continuing to widen. So the rich keep getting richer and the poor keep getting poorer. And this is because the world's richest individuals have accumulated more wealth than the rest of the world combined. And this is because these wealthy individuals tend to engage in tax avoidances and hide large amounts of money and their capital in tax havens. And there also has been a large increase in the salaries of corporate executives at really large corporations. So they're making many times, even hundreds of times, more money than the average worker at those companies. So I thought that this chart was interesting to share because it shows how the net worths of these richest individuals in the world at this time in 2016 are greater than the GDP values of the following countries. So for instance, you can see that Bill Gates' net worth in 2016 was greater than the GDP of the country of Myanmar. And Warren Buffett's, for instance, was greater than the GDP of Luxembourg. So the overall wealth of the world's billionaires at this time was about $6.5 trillion, which is greater than the GDP of Japan. So also, I thought that this graph helps explain why income inequality is on the rise. You can see that it shows that the richest 62 individuals in the world, basically comparing them with the bottom 50% of income earners. So the bottom line, which is the darker shade of black, are as the 62 individuals, and the lighter line on top is the wealth of the bottom 50%. And you can see that since 2010, the wealth of the richest individuals has increased, and while the wealth of the bottom 50% has decreased. And this is because the wealth of the bottom half has decreased by about $1 trillion in the past 5 years, and wages for average workers have barely changed pretty much. So there are negative impacts of increasing income inequality, and this is because it creates larger gender gaps in terms of pay, health, and education. And this is a problem because women already make up a majority of the world's bottom-earning workers. And governments also reap negative impact of tax avoidances from the world's wealthiest individuals, and this can result in the cuts of vital public services. So, for instance, in impoverished countries, people are denied certain resources. For instance, children can be denied their educational resources. And then this graph basically zooms in on this country in the United States, and it just shows how we're having a problem with increasing income inequality. And since 1980, you can see that income among the top 1% of income earners has increased greatly, which is the orange line. And the share of U.S. pre-tax income among the bottom 50% of income earners in this country has steadily decreased, and you can see by that in the green line. And this just kind of, these graphs kind of break it down in different countries. For instance, China and India, you can see that income inequality is becoming a problem there as well, and how the bottom 50% of income earners in those countries, in the blue lines, in both China and India since 1980 has decreased by about 15%.
Okay, so Kylie did a terrific job explaining why income inequality was rising, and I'm going to cover the argument that income inequality is not rising. So Dr. Max Roser makes an argument that world income inequality is not only not rising, but is actually going down. And he uses a lot of poverty examples as evidence. So we have this chart here. I got it from the Human Progress website. And it shows the world poverty line at $1.90 per day in solid blue, $1.25 per day in dotted blue, and it has the Economic Freedom Index. Economic Freedom Index is in red, and it's increasing. And that is basically saying that you're free to work. Their economic freedom measures how free you are to work, how free to choose what you do, and you're not locked into certain labors and things of that nature. So it's basically your freedom of choice in terms of the job that you like to select. So the case references a chart, but it was not viewable on the online textbook. So I created this chart in Excel. Now, one thing to note, I just wanted to portray a general trend here because the case was a little vague with the numbers, but they basically say that, or Dr. Max Roser makes the argument that the U.S., there's no doubt that the income levels was very high in early on, and then it sort of dropped in the 50s and then has gone back up since then. And there's a U-shaped distribution. So I attempted to illustrate that in Excel, and that's in blue. And then there's countries like Japan. And Japan has more of an L-shaped distribution in terms of income inequality. And it's a common misconception that people view the trends in the United States and think, okay, that is the trend for the entire world. When in reality, that's not necessarily the case. There are some countries that follow the United States, but there are also other countries that follow Japan. And he makes the argument that people view the United States pattern and say, okay, world income inequality is forever increasing now, and there's nothing we can do about it. And that's a dangerous proposition, he argues. So he says it's not as much of a global phenomenon as it is certain country policies that can create that. And when there's the disparity in one country versus another, we can sort of analyze and see what goes into causing those differences. And then research by Sir Tony Atkins points out the glaring flaw that many people measure income on a pre-tax basis. So that's what I want to ask you guys, those watching the video, and I think we could have gotten a good discussion had we had class. Is it a better measure of income inequality on a pre-tax or post-tax basis? So when you look at the United States, for example, we have a progressive tax system, which means that higher earners lose money due to taxes and lower earners actually make money after taxes due to redistribution of wealth. So after taxes, the poor actually have a higher income, and the rich actually has a lower income. The formatting here got a little bit thrown off, but the rich was going to have a red arrow, but the screen share sort of threw that for a loop. And then one stat that I thought was interesting was in the United States, the top 1% pays 37% of all taxes, while the bottom 50% pays less than 3% of all taxes. So in my view, and you guys can feel free to agree or disagree, is that it's flawed to look at somebody on a pre-tax basis because that's not money that actually reaches your pocket. And that's what Tony Atkins says as well. It's not like we make money on a pre-tax basis and we can go and spend that money. We owe a certain amount in taxes, and there's a much lower portion that actually reaches our pockets. And then on a global picture, the case references clearly a different poverty threshold than a lot of the charts that I found. So this chart was from a website called VOXEU, and it uses $1 a day poverty rate, 1970 to 2006, and you can see the poverty rate is decreasing. And then the case uses a different threshold. It didn't specify which threshold, but it said 90% of people lived in poverty in 1810. Then it went to 50% in 1981 and 17% in 2011. So no matter which threshold you use, you can see that the poverty rate is decreasing. Now, is that necessarily a measure of income inequality? That's something we can discuss. What's a measure of standard of living? Is it okay for the rich to get richer as long as some people come out of poverty, or should the gap narrow? Or is poverty a better measure, or is income inequality a better measure? So all things to think about, and we can discuss in message boards and things of that nature. And then modern day example for discussion. So Jeff Bezos, as of the beginning of March, when we put this PowerPoint together, he was worth $104.4 billion. Now that's fluctuated with Amazon stock and things of that nature. And around that time, Amazon announced that they were going to lay off hundreds of employees. Do you guys have a problem with this? I mean, he's worth so much money, and yet he's Amazon's laying off employees. That could seem backwards. Personally, I think I don't have a problem with this because he's got to separate doing what's best for Amazon to help that be successful, and then separating his own wealth. He's earned that wealth, and he has a right to that wealth. But obviously, people can have different views on that, and something like this can sort of contribute to income inequality, in that the CEO is worth an insane amount of money, but yet is laying off some of his employees. And then Kylie and I just have this list of discussion questions. We're not going to read them to you guys because you guys can sort of think about it. And I think we can generate some good discussions in message boards. Thank you very much for listening to our presentation. And these are the references that we used.
I need to stop recording. Oh, right there. Hit the stop.